But that doesn't tell the whole story because they've downgraded their margin by about 200 basis points, which is about 2 billion of EBIT. So the balance of that is coming from weaker China sales, lower pricing in Europe, lower demand in Europe. So just the demand and pricing environment globally has been very difficult, and that's part of the reason for the profit warning.
Which then leads us to Volkswagen. So the latest news today is that it's ending its job protections for auto workers in Germany as part of its cost-cutting push. These were several agreements that were linked to a 3-decades-old pact that was supposed to safeguard employment until 2029, but now those guarantees are going to run out by the middle of next year. I mean, wow.
Yeah, so, Volkswagen was in the news last week because it said it needs to close 500,000 units of capacity in Germany. So that's very difficult because of workers' rights. And, workers' rights have been very one-sided for Volkswagen in particular because you have VW law. And this is where 20% of the ordinary shares, the voting shares, are owned by the state of Lower Saxony, which is where Volkswagen's biggest factory is. And funnily enough, they have the ability to block certain agreements. So workers' rights are very strong for Volkswagen employees. And now I think management are saying, okay, hold on a minute. The automotive world is changing rapidly. We need to do something to reduce costs. And part of that is to close factories and reduce jobs.
Michael, give us just a 30,000-foot view of the global auto business here. I mean, the weakness that you're seeing in Europe, the weakness you're seeing in China, is that just general economic weakness affecting that we've seen in past cycles, or is this something to do with this ongoing transition to electric vehicles?
Yeah, it's a bit of both. So, you have the transition to battery electric vehicles. It's going much slower than expected in Western markets. Other markets probably going quicker than expected, such as China. But the problem Volkswagen has is that the competition is so intense and has overtaken them in China, such as BYD. So Volkswagen a couple of years ago was the market leader in China. Now BYD, within 2 years, has overtaken Volkswagen. And really, it's going to be a survival of the fittest in these markets.
Well, I mean, these companies aren't going to go under or anything, right? So I guess I'm wondering when the trough is. When do we know? What is a trough actually going to look like?
Well, you say, a lot of companies could go under, particularly the pure play battery electric vehicle companies.
But I mean, I just meant that Germany's not going to let Volkswagen go bankrupt, was my point.
No, of course. And the interesting thing, if you look at the valuation of Volkswagen, today it's valued at 45 billion euros. I've had a lot of clients talk to me about this today. They have almost 40 billion of cash on the balance sheet. Their 75% stake in Porsche is worth 45 billion euros. They own Lamborghini brand, which has higher profitability rates than Ferrari, which is currently valued at 77 billion. So we think Lamborghini's worth 30 billion if you use a Ferrari valuation. So the sum of the parts is Volkswagen is huge compared to the actual valuation of Volkswagen at the moment.
So you highlight an area for me that just kind of feels like a long-term issue, which is China. I mean, they spend decades, they being any auto company, Volkswagen, BMW, Mercedes, whatever, building brand value and brand loyalty in a market like China. And in a period of 2 years, they've lost that, it seems like. I mean, is that the real bearish case for some of these global auto companies?
It's a big case. So for the German automakers, in the past few years, China was the most profitable market. It accounted for 35–40% of their profits. Now, this year, it could be as low as 10%. And, what the market's pricing is that could be zero in the future. And that's because the technology changing and the way that startups in China are pushing through so quickly. They're really fighting for market share at the moment and their future.
So then it goes back to my question. What does the bottom for either U.S. car companies or for European car companies wind up looking like as the tariffs go into place, as China keeps producing these really cheap EVs, as we have different restrictions here in the U.S.? What is that?
Well, you look at what GM and Ford have done. I mean, GM in particular, it's looked at different markets, and if it's not profitable, it's pulled out of those markets. Right. So China is one example, Europe's another example. So it's whether the German automakers take a view that can they be profitable in China in the future. And many foreign car makers are saying no. Volkswagen at the moment is saying yes, we can. And they've got this long-term plan, and they've invested in XPeng to hopefully accelerate their transition. But it's going to be very, very difficult for foreign car makers to continue to make profits in China.